Wow. What a finish to the week in the stock market, folks. We've got to give the flowers to Mr. Dan Bird. He's been telling us this was coming. Lots of us, myself included, did not want to believe it. On Friday, we saw the Russell 2000 have an amazing day, I think up 3.5%. We saw the VIX as a teenager. We're not talking 19, 18. We're talking 14.6. We had the Dow up 700 points and Nvidia was flat. What is going on? Is the market broadening up, broadening out? Are we on pace to have record highs? We had a jobs number. We have, I think, what is still going to shock people, a shockingly low inflation number in about 8 business days. Dan, you nailed it. I will admit I was suspect. I didn't want to believe it, but take your victory lap, man. What's going on?
Nobody wants to believe it.
Yeah, no kidding.
Everyone wants to wait till the lifeguard says it's safe to go back in the water.
Yeah, it's pretty wild.
We had breakfast with some friends of ours this morning, and his son is a financial analyst for a hedge fund. Mm-hmm. Now he specializes in the energy sector, which hasn't been doing too great lately. And he's on my newsletter too, by the way. Okay. And he asked me, what do you think? What's the market going to do? He says, I'm talking to my son. And I said, is it time to get back in? Is it time to put a toe back in the water? And I said, what did your son say? He goes, no, absolutely not. Definitely don't go back. It's going back down. And I said, well, maybe you need to send him my newsletter.
Yeah.
I said, did you know that with the bear market that occurred in 2022, did you know that we're more than halfway back from that?
Yeah.
And he's like, what? You're kidding me.
Oh, yeah.
No, I didn't know that.
Yeah, crazy.
So yes, we'll talk about all those things. And let me start with my newsletter, actually.
Yes, please. Again, people got to get this newsletter. It's free, you don't sell emails, anything like that. You do this for yourself, and right. You bring it to my channel here for well over a year. So if people aren't getting this, they really should.
Yeah, they should. A lot of people do get it, but most people don't read it other than the cartoons. I will admit to reading it about twice a month. So I'm about 50%.
Right.
That's fine. No problem. I don't really care if people read it, frankly.
Yeah.
I do it for my own research, and then I just put it all together and send it out. But I like this cartoon up in the upper right with the bowl sitting behind the table. And the glass jar says FOMO.
Yeah.
That's where we are. Right. We are on the verge of FOMO.
Really? Oh, so on the verge of FOMO, meaning Friday wasn't FOMO. It might be coming this week.
Friday, it probably will come this week and next week. Might be even more next week. But Friday was the start of it.
Okay.
Friday was the start of FOMO. So one thing I put in the newsletter is, and I try to do this every month. I didn't put it in last week's, and one of your listeners I noticed on the YouTube channel said, I was looking for the market performance for June, and you didn't put it in there. And I had to I showed this on the call, and she goes, I had to do a screen capture to get it. Well, I put it in this week. I try to do it every month before the new month starts.
Right.
But sometimes this comes from Stock Traders Almanac, and sometimes they put it out late. So now all they do is put in the dashed and solid lines that show the trend of the market, and then they put in the trading days, which trading day it is at the bottom, and then I add in these other lines and informational pieces, and I add in the actual dates of when those trading days are.
Yeah,
so you can actually see the weeks.
I got to tell you that June 13th, that 5:30 report on CPI, I think is going to shock people.
That next week, all next week, it's going to shock people.
Yeah, this week is light on economic data, but next Tuesday, woo, watch out.
Yep. CPI report. We'll actually talk about that next week.
Okay. Yeah.
I don't want to talk about it this week, but
no problem.
CPI report, and then the very next day is will the Fed hike again or not?
No, they're pausing. I keep telling people.
I think not. Yeah, and then options expiration is on Friday. So the week after next is going to be very busy, very volatile week. So there's a few things I touched on in my newsletter that I want to talk about in this first segment. But let's first look at the VIX, since you mentioned that.
Yeah,
so
14.6. I mean, wow. Look at that. It's under 15 on your chart. It's just, it's the lowest it's been in years.
Yes, it is. In fact, I could go back. Let's go back 10 years and see what it looks like. Well, it's much lower in 2020, and actually even before 2020, it was lower. Lower in 2018.
Yeah,
Real
so
low.
you got to go back to the beginning of 18 to be lower.
Yeah.
Actually,
Oh, no,
there it is. No, 20.
No,
I'm sorry.
it's 20.
Yeah, I see. 20. Yeah, 20.
Yeah,
Okay.
just before the COVID crash.
Okay, I stand corrected. Yeah.
But the important thing is, you cannot have a bear market. We have never had a bear market.
No.
When the VIX is below 16.
Now let's remind people what the VIX is, because we say it like we know what it is. Generally speaking, the VIX is a fear index, correct?
Yeah, it's called a fear index. It's a volatility index. It basically calculates the options volatility 30 to 45 days into the future. So it's not necessarily, now remember, options are time component trading vehicles. So when you buy or sell an option, you have to figure out a date for it, right? And most options buyers are going to be buying 60 days out or more. Option sellers are going to be selling usually 45 days or less. So this looks at 30 to 45 days into the future, what it thinks the volatility will be. So it's kind of looking into the future to see what volatility is, but it's affected by what happens in the market right now.
Correct.
So when the market goes down, volatility goes up. And when the market goes up, volatility goes down. So another way to think of that is volatility in options trading is much calmer when the market is calmer, or the market is going up. When the market is going down, which it usually goes down much faster than it goes up, the volatility starts to spike, starts going up, because a lot of people are getting into puts, buying puts to protect themselves, that type of thing. So this is basically measuring volatility in the options market. And people call it the fear index because it usually spikes when the market is going down. If you look at this chart where we had the spike back here, the end of last year. Now October was the low so far, right? And by the way, this low in October is 34.91 on the S&P. 7 out of the last 14 bear markets have ended in October.
Yeah, and I remember you told us that last October.
Right.
So it's kind of wild.
7 out of 14 have ended in October. But you can see as the market was going down into that October low, you see the VIX was spiking higher. Now, the way I have my chart set up is it's using a 5-day and a 21-day moving average. That's what the red and green lines are.
Okay.
And then the gray is the actual number in the background. So the way I have it set up is that it will turn green as the VIX starts to significantly decrease as it goes down, because that means the market's going up. And you can kind of follow that down here. Here's the market going up, and you've got green going down. So right now we had a little spike back in April, or actually that's May, back in May, the end of May. But ever since then, really since the Nvidia number.
Yeah, correct.
The VIX has just been dropping and the market has been taking off. And you can see the 10-year Treasury down at the bottom down here. Now the 10-year Treasury has sort of been oscillating right around 3.5%. It's gone a little bit higher lately. So normally when the 10-year Treasury goes higher, the market goes down, but that hasn't happened this time. So the 10-year Treasury might be telling us that it is fairly priced. So we'll see. But yeah, there's the VIX. The VIX is at ridiculous lows.
Yeah, and I remember, and then if you want to talk about the Russell 2000, and the big question for me last week, and again, their videos on the channel was, will the 5 to 7 big stocks break down, or will the everybody else broaden out? And I think the Russell 2000 had their response Friday.
Yeah. So in last week's newsletter, I showed the Russell 2000. I said, the market doesn't have enough breadth. It's being led by a few big, huge technology stocks. But if the market is going to go back to new highs, then it will broaden out and the small and mid caps will start to participate. And I said they might be setting up to do that. And what I showed back then, I don't have this chart today, but what I showed was if you look underneath the covers of the Russell 2000, if you look at the growth versus safety stocks, value stocks, growth versus value, even though the Russell declined and then has just gone sideways since March, the growth versus value has spiked higher.
Right.
So inside of the Russell, Wall Street is positioning themselves into small and mid-cap growth stocks. Wall Street was telling us they're getting ready for a spike higher. They're getting ready for much wider breadth in the market, which is going to lift everything. It'll lift the whole market. So those internals, which is what I look at all the time, those internals were giving us an indication of what was coming. All right. And I suggested, this is not a recommendation because we're not here to give financial advice. This is just educational. One of the things I suggested last week was to look at TNA, which is an ETF that is 3 times the Russell.
Oh, wow.
So it's a leveraged ETF. So this was up 10% on Friday. The Russell was up 3.6%.
Yeah, 3.5. Yeah, 6.
So the TNA will do 3 times whatever the Russell does. Now it's based on the Russell, so you have to watch the Russell chart before you get into it. But you could have got 3.6% just buying the Russell, or you could have got 10.7% buying TNA.
Yeah.
Now what I did, just for full disclosure, and I put this in the newsletter as well, when I talked about this last week, and it looked to me like it was going higher. Now, if we go back 5 days, there's Friday, Thursday, Wednesday, Tuesday, Monday. So last weekend, it was this red one here that was below the moving averages. You see that?
Right. I do.
So what I did was I put an order in right at the moving averages at 30.
Okay.
But it traded down to about 28.5 or so.
Okay.
So I put a buy order in at 30 just in case I was right and it took off.
Yep.
And it did. And my buy order executed.
Okay.
So now, since it had a 10% run, and anytime you get a 10% run, this is just a suggestion for anyone trading. Anytime you get a 10% run or somewhere in that neighborhood, 9, 10 or above, you should move your stop up to 50% of that to make sure that you don't lose more than 5% of that gain.
Right. Okay.
Now I moved it up to break even, basically, right at about 30.
Okay.
So it's a little bit below where it executed. But I am practically in this at no risk whatsoever. And if it continues to go up, then I'll move it up to 50%.
Yeah, this is the key, right? One of the things we should do one time is do a Sunday deep dive talking about risk mitigation, how to move stops, all of these things that I've never done, never really investigated, is so helpful for folks. So we may need to think about doing that.
Absolutely. Yes, we should. We should do a whole session, actually.
Yeah, exactly.
Make that part of it and just open it up to questions from people.
Yeah, I think that should be. I think that, folks, if you want to do something like that, leave a comment below. Dan and I will look to maybe get something like that scheduled. But you got to tell us you're interested in that. So let us know.
Yeah, what I'm thinking is a session, kind of like a Zoom, where it can be interactive, live.
Yep, that'd be my hope.
Where people can ask questions, and it will be somewhat structured in the sense that I'll talk about technical analysis. I'll make some recommendations on a entry level chart. What are the things you should have on a chart if you're first starting out? And then we'll talk about some of these things, moving averages and where to put stops and risk mitigation and that type of thing.
Yeah,
all stuff I am
not good at. Yeah, and then always open it up. That's a big thing I want to do on all my sessions, is just let the audience ask questions, which will be.
Yeah, we could even have at the end a session where people just throw symbols out.
Yeah, maybe.
I'll bring the chart up and give my impression of what it looks like to me.
Cool.
So
So again,
Nvidia, you
folks,
talked
let
about.
us know. Yeah, I thought Nvidia was really interesting because again, Nvidia started all this. It may have been the spark that led to it. Um, and frankly, Nvidia did nothing on Friday. It was boring when the Russell's raging up 3% or whatever. Nvidia is just like, nothing.
So Nvidia was one of those Big 10
Mhm.
that was driving the market.
Yep.
And my perspective on this, and I mentioned last week that I bought a little bit just before earnings way down here.
Yep.
And I said last week that there's no way I would buy any more up here
Right.
because this is usually what happens. In fact, it's actually a very healthy thing that it didn't do anything.
Right.
It's actually a bullish sign for Nvidia that it didn't do anything. It just went sideways because that is a continuation pattern if it continues sideways.
Okay.
And the continuation will be from the point where it started this big gap, about 300 up to 400. The continuation will be the same distance. So if it continues to run into the end of the year, it could go up to 500.
Got it. Okay.
But the fact that the rest of the market took off and Nvidia didn't is actually a good thing.
No, I agree. I think when I saw that, because again, I'm not the stock guy, but I did look after hours. I saw the Russell, and then I'm like, my expectation was, again, this is your world, not mine. When I saw the Russell up 3.5, I'm like, oh my God, is Nvidia 450 now? And then I looked it up, it was like 50 cents. I'm like,
Right.
This Dan Bird guy knows what he's talking about.
Here's Microsoft. I mean, it didn't do much either. AMD didn't do much.
So this is again, folks can go back. You
Google.
have a playlist called Dan Bird. They can go back and watch last week. You were pretty adamant that to get to the record highs, which is 4,800 and change, you would need the Russell 2000 to take off. You talked about it, and
Yes.
you kind of got your dream, and you got it because of the jobs number. You talked about that, and your other call that you've been pointing at for at least 2 weeks is you expect inflation on the 13th to be significantly down. We're talking 4.1, 4.2, 4.3. And
Yes.
by the way, I asked my Wall Street guy, Taylor from Life Goal Investments. He looked it up on Monday and he said expectation is 4.23, I think. That was the expectation as of last Monday.
All right. Yeah, that's very reasonable.
So it's
it
pretty
might
wild.
Come in lower than that.
No, it's certain. I think it could. We're rolling off the largest base effect, like we've talked about. Yeah.
Yeah, we'll show that next week before that, next Sunday before the CPI. We'll show why I think it's going to come in much lower.
Do you think it could have a 3 on it? Do you think it could have a 3?
That'll be a stretch.
Month.
That's a stretch. I think
next month.
Next month, yes, because we're rolling off another big one next month.
Exactly, 2 in a row. Exactly right.
It could be 3.5 in 2 months or 6 weeks.
Yeah, 6 weeks. Yep. Okay. Sorry.
Here's the long-term chart. This is what I've been talking about for months now. Folks can go back and look at the previous videos. This is a weekly chart. This goes back all the way back to beginning of 2021. So there's the big run up to the high, the all-time high up here. These quadrant lines, these two blue lines, this one down here is the 50% point from the big rally, from the big bull, from the bottom in 2009. So this line here was 50% from the low to the high up here. That was halfway. This is the 75% from the low to the high. So we got to the high, we retraced all the way back 50% of the distance from the COVID low. And we hit 34.91 in October. That was the low. And then we started coming back up. And these pink lines here are anchored on the all-time high up here at the end of 21 and the 34.91 low in October. That's where these pink lines are anchored.
Yep.
All right. So this one here is the 50% point right here, this dotted pink line. And I said last week, we are more than 50% back from the low. And after last week, we're even more than that. Can you see that candle right there?
Yep.
Right. You might even be able to make it a little bit bigger. There you go.
Yeah, there you go.
All right. So last week we were more than 50% back. We're even more than that now. And I've had this shaded area in here basically ever since November or December, when we started going back down again. That's when I drew this line across here. I said, that's the resistance we got to get through, which is at 4,100.
Mm-hmm.
So I was saying all along here, we got to get through 4,100. And when it started coming down again, I said, we can't go below 38.2% Fibonacci, which was 38.15. We went down to that and didn't go through it.
Mm-hmm.
In fact, I said at the time, if we do go through it, we might be going to 3,200.
I remember. And I was excited. I felt like I was going to be right. And then
I know you wanted to buy something.
I did. Darn it.
But we didn't. It reversed.
Yep.
And now we're more than halfway back. So this is the battleground area in the shaded area. This is where the bulls and the bears are duking it out.
Yeah, let me ask you about Friday. That candle Friday. That was because I remember last week you pointed, people can go back and watch it. You were pointing at 4,300, and what the body language or what I was reading from you is like, Michael, this might take us, several weeks to have this out. And then Friday happens and you have it all in one day. You and I are texting each other, and I'm like, shh, it all happened in one day.
It all happened in one day, and that's what happens in the market sometimes. Now, one thing I said last week, and this is a technical analysis, so it might be a little more than most people will understand, but can you see the long tails on these? This is a weekly chart, remember, so this is 1 week. Each one of these is 1 week.
Yeah, not a day, it's a week. Yeah. Mm-hmm.
Right. So you see the long tails on all of these?
I do.
All the way back here, when we hit this 3,800 level, we went below it, but we closed above it.
Mm.
And these 3 weeks had long tails on them. Even the red one had a long tail on. Mm. This long red one here was really there was 2 bearish weeks, but this was the worst one right here, when it went right back down here and then bounced. But these long tails, what they're telling you is the market sells off all the way down to the low, and then big Wall Street traders step in and they say, thank you very much, retail people.
Yeah.
Thank you so much for getting scared out of your positions and selling because you think the market is going way back down to 3,200 again.
Yeah.
Thank you. Thank you. Thank you.
Yeah.
And
yeah.
They step in and they buy all those shares and they push it right back up by the end of the week. Same thing happened on Friday. You can see it didn't look too good at the beginning of the week.
Yeah, no, you're right.
Market was selling off, but Friday came roaring back. So we ended right at this resistance line, right at it.
Do you think Monday's a continuation? Because again, we've had a weekend. All the articles have been probably talking about the stock market racing. You're probably going to get that FOMO. So do you think retail piles in Monday and we blow out, we go above 4,300? Is that kind of what you see coming, or you don't know?
I think we will. Now, keep in mind that Mondays historically are the worst day of the week.
Oh, okay. Didn't know that.
So Mondays often will have a pullback. Mm. But we don't really have much in the way of news next week.
Yeah, it's a really light economic week. We get some, we get unemployment on Thursday. I think we get factory orders on Tuesday or something, but really nothing. And the Fed's not talking because they're now in their blackout period.
Fed's not talking. We're through the debt crisis, ceiling crisis.
Yeah.
So we're done with that. In fact, really over this weekend.
No really crazy earnings coming out that we should pay attention to. Yeah.
Yeah. So I don't think there's any catalyst to push us back down.
Okay.
So, the market normally doesn't run up 3 weeks in a row like this and keep going higher. It usually needs a pullback, and it's actually healthy if there's a pullback. So we might get a little bit of a pullback on Monday, but I think because there's not much news and there's still a lot of momentum, and I think there's a lot of the FOMO trades are going to step back in and say, oh my God,
I missed it. Yeah.
Oh my God, Dan said we're up more than halfway back. I'd never even realized that. I better get in.
Ooh, okay.
I don't think they're listening to me, but
yeah, they hear selectively.
Yeah. I mean, people are still talking about recession, which we're going to talk about here in a second. But yeah, I think next week I don't know if it'll be Monday, but I think next week we will definitely get above 4,300.
So you think we'll have a close, just to fine point? We think we'll have a close above 4,300.
Yes, we'll have a close above, and I think we will then very quickly get up here to 4,450, 4,500, where this next level is.
Wow, this
and then 4,600 will be the biggest one to get through. That's where the market will pause and decide what it wants to do. And that could be through the summer. I mean, we could bounce.
It could be
around
a while.
We could bounce around in this area through the summertime. Now, technology stocks historically do well between now and the middle of July. In fact, the week of July, and I've watched this for years, the week of July and the days right around July 4th in particular, always have a very bullish bent, no matter what the rest of the market is doing. The week or so right around July 4th is always bullish.
Interesting.
So I think, we might push through here and, get up to this next level in the next few weeks. And then through the summer, I think we're just going to bounce sideways.
Okay.
And then at the end of the year, all hell will break loose.
Well, this will be fun to watch. I know you're coming back every week to kind of talk about this. Next week will be fun because we set up CPI. Any closing thoughts as we get into video number 2?
I want to touch a little bit on recession. This is the closer in view of the S&P, so you can see where it broke through the congestion here, broke through all the resistance lines, and now we're heading up to 4,300. So let's talk about recession. I put an article in my newsletter about this, because there's still a lot of talk of recession, and people are still, saying recession's coming.
Yeah, just so you're clear, I'm saying that on my channel as well. So you're pointing at me.
I know. I've heard. Okay. You said we're already in a recession.
I do. I believe one started April. Yep.
Right. So there's 3 things that I look at, and I put this in the newsletter. I actually listed the 3 things that I'll watch.
Okay.
Number 1 is the inverted yield curve. So I've heard plenty of talking heads on CNBC say we're definitely going into a recession because the yield curve's inverted.
Yep.
And every time it's inverted, we've had a recession. And that's not necessarily wrong, except for in 1998, we had an inversion and there never was a recession.
Yeah.
So it's not every time, but it's most every time. But if you actually look at it, you'll see that the inversion itself does not result in a recession.
Correct.
And this is true every single time. All the way back as far as I can view. I mean, my chart can only go back to 1990, but it's even true of this 1990 recession back here. The recession does not begin until the yield curve gets back above 0.
Yeah, it reinverts. Yeah.
It reinverts or uninverts. So in 2000, it took 4 months from the time it went back above 0 before the recession. In 2007, it took 6 months. It actually went above here and it took it 15 months, but it went back below. And then when it came back above, it took 6 months. In COVID, it took 5 months. Look how far away we are right now.
Yeah, we're not even close. Yeah.
Not even close. So we got a long way. We got a long way to go before we even start counting the months.
Before it even starts, the clock has even started. Yeah, I understand.
Right.
I understand, Dan.
The clock has not even started. Here's the Fed rate. This is the second thing that I watch. Fed rate. Every single time in a recession, the Fed starts dropping rates. 3 to 5 months before the recession starts, the Fed starts cutting.
Yeah, they haven't even paused
every
yet.
time. Every time.
You're right. Okay.
All right. So the Fed cut here, there's the recession. Fed cut here, there's the recession. Fed cut here, there's the recession. These blue lines are when the Fed started raising rates, because I wanted to show what the market does when the Fed starts to raise rates. So these blue lines is when they first started raising. And each time you can see the market drops initially, and then it takes off. Especially in secular bull markets. Secular bull markets are these green squares right here. And everybody that's listened to me on this channel should understand now that that is the basis of all of my analysis. Is secular bull and bear markets.
Correct.
So in each case, now this is one time here, even in this is a secular bear market right here. Even in this case, the Fed started to raise rates, the market dropped a little bit and then continued to take off. Right here, the Fed started raising, market dropped, and then it took off. Right here was where the rates started right here, the market dropped, and then it took off. So This is telling you two things. First of all, the recession doesn't begin until the Fed starts dropping rates. That's going to be at least a year, I think, before that happens. And
Okay.
when the Fed starts raising rates, it doesn't mean that the market, drops and never comes back. It actually comes back pretty quickly.
Okay.
And then the last piece, the last thing I look at, and this is a lagging indicator, is
jobs.
Is the jobs, the unemployment rate. So every time before a recession, and this happens pretty close to the recession, so it's not a few months out, it might be just 1 or 2 months away. But the unemployment rate begins to spike materially. Mm-hmm. And by materially, I mean 0.5% in 1 month. Mm-hmm. So we had a 2% increase this last month.
0.3. 3.4 to 3. Oh no, 3.5.
No, 3.4 was the month before. So
you're right.
You could actually look at it that way. I mean, 3.4, 3.5, and then 3.7. But
you're right.
0.2 from the last one.
Correct.
But it really needs to be above 4. It needs to get above 4 before this is even going to affect. But you can see here, this goes all the way back to 1950. So the blue line is the unemployment rate.
Yep.
You can see just before the recession, that starts to spike materially higher. None of those three have happened yet. None of them.
You're right.
So I continue to say we are not in a recession. We will not see a recession until sometime next year. We probably will see a recession, but it will be
we're
brief.
Absolutely going to see one, but
it will be brief and shallow, short and shallow.
This is why I love having you on the channel, because you and I don't agree. Also, our expertise lie in very different areas. So I appreciate you here. I will not change my opinion. Because again, I own it. When I make a mistake, I admit it. 3 great facts. I appreciate you showing them.
Yeah. By the way, I don't know if you noticed it on this chart, but I also put in when the NBR calls and ends a recession.
Yeah. It's always so late.
Yeah. So this recession here that began in March of 2001. Yeah. NBER didn't call it until November, 8 months after it started.
Yeah. Good job, guys.
In fact, it ended in July. So they call the beginning of the recession 4 months after it ended.
Oh, that's funny.
Right. So we're not even going to know officially if it's a recession until 2 years from now, probably.
Yeah. Agreed.
So if you're waiting for the recession, or if you're waiting for the recession to be over, then
you got a while.
You will miss the sweet spot.
Well, Dan,
so if anybody's interested
in
my newsletter, just send me a note to breakpointtrading@gmail.com. And I'll get it out to you. And in the next session that we do here, we're going to talk about the comparison between the AI craze and the .com craze.
This should be fun. Thank you, buddy.
All right. Take care.